Today we will cover quickly the types of insurance for our consumer skills module. And firstly, it is just incredibly important that we have insurance because of the chance of risk. And risk is just going to be any time that we have an event that we can't entirely control. Thank you so much. Where we are unsure of what the outcome might be. And ways that we can manage this risk are going to be through emergency savings accounts, which we talked about in Unit 2 and 3, where we want to have at least 6 months of our expenses set aside in case something unexpected happens, in case we lose our job, we have to quickly move somewhere, something like that, where we aren't really sure, what might happen, but we want to have some money saved up to help us get through that situation. And we couple this emergency savings plan with insurance, and insurance is just that product that we can purchase to help us mitigate the risk and prevent any future or more loss than we've already experienced. So we combine these together to really, really reduce the risk in our lives. So some important terms that we need to know when we are thinking about an insurance policy. And at this point, we're just thinking about a really vague insurance policy. So we're not thinking about a specific type, but just about insurance in general. And the first thing that we need to know about is what the policy is. And a policy is just going to be that formal, legally binding contract between an insurance company and between you or the person who is the head of your insurance for your family. And it's going to state a lot of information, and it'll state exactly what is going to happen based on your insurance that you are paying for in your insurance agreement. And so that policy will cover, or it will include, your coverage amounts. And coverage is just going to be how much money that insurance company is going to pay you if your items are lost, if they're damaged, if they're ruined, things like that. So coverage is how much am I actually going to get paid based on my policy. It will indicate who the policy holder is, and a policy holder is going to be the person that owns that insurance policy. For you right now, that's probably going to be your parent, your grandparent, your guardian, maybe even a sibling. But in the future, when you turn 18, you are going to be able to get your own insurance policy if you'd like, and then you would become the policy holder. And then finally, your policy is going to state your premiums. We do have to pay for insurance, and normally we will do this monthly, and so we will have a monthly premium. That is our way of purchasing this policy, and our policy will actually indicate, or our contract will indicate what that monthly premium is. We're going to skip through this example. All right, insurance offers us two huge benefits. So firstly, it's going to just give us the ability to get a cash out in case something serious does happen. And it usually is going to far, far exceed the amount that we have actually paid. So I may pay $100 a month for my insurance policy. But if I actually need medical attention, that might cost tens of thousands of dollars. And so while I'm only paying out a small amount in comparison, I'm only paying $100 a month. If I need it, they will be able to pay tens of thousands, if not hundreds of thousands of dollars as a way to help me in the future. And then it also just gives us some peace of mind knowing that we have some financial security to back us up in case anything were to go poorly. And the 5 main types of insurance that we're going to talk about are property and liability, health, long-term care, disability, and life insurance. And the 2 that we're really going to focus on are property and health because those are the 2 most widely encompassing in types of insurance. Regardless of the type of insurance, they're all going to have a pretty similar process though. So we start off where there's an event in our lives that occur and that causes us to have some type of loss. Or possibly that loss could be just damage to our items. And so the policy holder or someone who is in charge of the policy is going to make a claim with the insurance company. So they're going to call, or maybe they'll go online and they'll file a claim. And a claim is just a formal request to the insurance company asking them to pay for the loss or the damage that we've experienced. The insurance company is going to look over our policy and decide if it's covered. Sometimes we might have an insurance policy that doesn't cover all of the damage or all of the loss that happens based on the event that we experienced. And so they could potentially deny us from coverage, but if they do approve the coverage, we pay what is called a deductible. And a deductible is any money out of pocket that you as the policy holder have to pay before the insurance company will pay any money themselves. And then additionally, one uncommon feature in insurance is what we call co-insurance. And most people do not have co-insurance because it costs more money. So co-insurance is going to be when a policyholder has to pay even more money on top of their deductible before the insurance will cover the remainder. And we'll see an example of what this looks like. So for this example, we have Louise. She was in an accident and needs medical attention. Looking at her policy states that she has a $500 deductible and a 20% coinsurance. That means that she has to pay $500 guaranteed. And then in addition to that $500, she pays another 20% of all the remaining bills that are based on these medical expenses. So she's in an accident, she has medical expenses of $5,000. So she initially pays $500, which brings her balance from $5,000 to $4,500 because we take in $500 off that. So she will pay 20% of this $4,500. So once she pays that 20% and her deductible, she has paid a total of $1,400 for these medical expenses. The insurance company will pay everything that's left. So the insurance company will pay $3,100 for these medical expenses. We're going to skip through this activity as well. Now we're going to focus on the sources of insurance. So we could purchase our insurance individually. We might do this for some specific types of insurance, which we will get to here in a second. But usually when we purchase insurance individually, it is far more expensive. So we're not going to focus on that source of income today. We're going to focus on employer-provided insurance and government-provided insurance. So our employer-provided insurance, we know that this is seen as an employee benefit. We learned that in Unit 2 as well. So for your note guide, an employee benefit is just a product or service that adds value on top of the actual wages, the hourly or salaried amount that your employer is paying you. And we call this in-kind income. So in-kind income is any time that your employer is going to be donating to your monthly premiums or donating to your retirement, rather than just giving you cash. So by your employer paying some of your monthly premiums through an employee benefit, they are offering you in-kind income. And then the remainder of the premium will come from us as the employee. And we'll see this as a payroll deduction. And we saw that in Unit 2 when we did our pay stub calculations. Additionally, the government offers some programs that can be a source of income as well, or a source of insurance. And so the government is focused on providing basic insurance packages through Social Security and through Medicare and through Medicaid. And so that's a way that they can provide really just the most basic insurance to those who need it. Additionally, the government is going to try and reduce people's risk by protecting those who are out of work through unemployment and workers' compensation. And then lastly, they can try and reduce people's risk by having government programs set up to address natural disasters, catastrophes that are harming some of our citizens. So things like Hurricane Sandy or Katrina. There were government programs that helped those people or went down who were affected or went down and tried to provide services to those who were affected by those natural disasters. Now we're going to get into those 5 types of insurance. And like I said, we're really going to focus on health insurance and property and liability insurance because those are the 2 most wide-spanning insurance types that exist. So starting off with health insurance, this is just going to be any type of money that goes towards health care or to medical bills. And this could be provided through an individual plan that you may pay for on your own, through an employee-provided plan, or through the government if you're using Medicaid. And the reason that health insurance is so incredibly important is because medical bills are very, very expensive, some of the most expensive bills that many people might receive. And health insurance often covers a wide variety of risks. So not only are they going to provide ability for you to go see the doctor and get preventative care, but health insurance also includes vision care and dental care. So you can go to the dentist, you can go get contacts or glasses. It'll help you with hospital bills if you have to have surgery or a medical procedure. And sometimes it even helps you pay for the medication itself. A smaller type of insurance is going to be disability and long-term care insurance. And a lot of people try and lump these together, but they are very different. So disability insurance is going to be payment to those who can't work anymore, whether that's due to illness or to injury. And this can be provided by an employer, by an individual, or by a government. So all 3 of those sources of income can play a role in disability insurance. The main difference between disability and long-term care insurance is that long-term care is going to be payment to those who have to be in a nursing home or a rehabilitation facility, but so they are not well enough. These people are not well enough to stay at home, but they're not unwell enough to need to be hospitalized. And so because they are kind of in that middle ground, they have to provide this insurance individually. So if I'm worried that one day I have to go into a nursing home, I will have to individually research and pay for long-term care insurance myself, unlike disability insurance, which does have government and employer-provided situations. And then back to one of our other biggest types of insurance are going to be property and liability insurance. And so property insurance is going to be that insurance that provides protection to my items or my property. So if I have a damaged item or a lost item where it is just ruined, it is going to pay for the loss of the insured person. If I am the property or I'm the policy holder, it will pay for my property. The opposite is true for liability insurance. So liability will pay for the damage or destruction of somebody else's property. So it pays for injury or loss to others. If I have liability insurance and I do not have property insurance and I get into a car accident, my insurance company will pay for the other person's car. They will not pay for mine. And so if I want to be fully covered, I need to have property insurance and I need to have liability insurance so that my product or my items and my property are protected as well as the property of others. An important thing to note is that property and liability insurance only come from individuals. Your employer and your government will not offer these to you. We have 3 types of property and liability insurance. So the biggest one is going to be auto insurance. You are legally required to have at least liability insurance on your vehicle. So if I choose to drive, I have to pay for liability insurance to protect others around me. I do not have to have full coverage. So if I get in a car wreck with liability, they'll protect the other person's car and mine is just out of luck, or I can pay for full coverage and protect both of our vehicles. Homeowners insurance, if you choose to purchase a home, is going to cover the structure and any personal property inside of a house in case there is a flood, an earthquake, maybe a house fire, things like that. And then renter's insurance does the same thing as homeowners insurance, but if you choose to rent rather than purchase a home. And then just again, liability insurance is required if you have a car. Then our last type of insurance is going to be life insurance. And life insurance is going to be payment to a specific person if someone else were to pass away. and that specific person is called a beneficiary. And a beneficiary is just that, again, that person who receives money if an insured person passes away or dies. And a lot of times this beneficiary might be a dependent, or a new guardian for a dependent. And we know from Unit 2 that a dependent is somebody who relies on someone else for at least 50 to 51% of their living expenses and their care. Life insurance may be purchased individually, or it may be provided by an employer. And this is usually going to cover wages that you would have earned at your job, especially if you go through an employer, it's going to cover wages. Individually, you may be able to also cover what we call household production. And that's in addition to wages, that would be things like payment for childcare or payment for groceries and other expenses that were not included in those missing wages. And that is the end of our insurance lesson. So just remember that insurance is incredibly important in our financial plan. And it is better to take preventative measures, pay for insurance to reduce our risk, than to end up in an unfortunate situation where you do not have insurance.